Everybody, so let's take a look at the ES, crude, and gold, and I'll show how the accumulation was done. So, all right. So we'll just start off right here, or maybe I can go a little bit back. Right. So this is the market going down. This is on the ES, it's going down, 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 down. And what you see is finally there's a print here. And that really doesn't mean much until there's a move after it, because you can't tell, no matter what tool you use, you can't tell whether it's real buying or selling. You just know there's a trend, there's a lot of volume that's being traded there. I know a lot of folks think Delta will do the trick, but it doesn't, because it looks at aggressive buying and selling and doesn't really account for the limit orders. So basically the volume picked up here, and you don't know what's going on. You just know that this is a low, and then it breaks, and then volume picks up and it goes sideways. As it goes sideways, the market's still going down, it's bearish. It's only after this rally that you will know that this is accumulation. All right, so you have the high volume here, followed by the aggressive rally, which is the biggest in 49 waves, meaning the biggest volume in 49 plus waves is right here, 49 plus up waves. So that is the key indication. Buying here, meaning the sellers sold, the buyers bought. The sellers sold, the buyers bought. Sellers sold more, buyers keep on buying. And the result is price goes up. Why? Because they're not willing to sell anymore here. If they're not willing to sell anymore here, price will go up. So what happens is you have buying and selling taking place, and that's what volume is. It's just measuring the buying and selling, and it increases. And after it increases, there's a directional move, and that directional move is the key indicator of what's really going on. So, and either it's going to pull back and give you an opportunity, or it's not. So here, you have that buying right here. This was 18,000 contracts, and a big wave after. Before you had a lot of volume, you had little waves. Doesn't mean shit. It's only after it has a rally, and then there's like the buying in the background. What happens is the market pulls back and tests, and they're reaccumulating right here. This is significant. Well, first of all, when it pulls back up here, they're selling. You know why? Because it's a downtrend, right? So even though the buyers accumulated here and took price higher, the sellers who are at these levels said, all right, you know what? It's at our level, let's sell. Right? And they take it back down, where the buyers come back in. And how do you know? 32,000 here. So you have buyers buying around 18,000 here, but more on the sideways action. They buy a lot here. They push it up. The sellers step back in, right? Because it's a high. They sell. These buyers, they step back in and buy. Why am I more bullish than bearish, even though there's buyers here, sellers up here, and then buyers there? Why am I more bullish than bearish? It's because of the size of this move, and the volume on the way up is too much. It's 3.1 times average volume, biggest in more than 49 waves. So clearly, even if sellers are going to sell this, there's a lot of buyers. They say, okay, you want to sell? We'll buy whatever you have to sell. Sellers were here. Buyers were here, picked up the selling, shot it up. Sellers came in, shot it down. Buyers re-stepped in. 32,000 plus 17,000, giving the entry opportunity here, low risk, very low risk entry opportunity. And then it went back up. And then they presented themselves again right there. The 20 and the 27. So they presented themselves right here on the 20 and the 27 on the up wave, at the very top, which is exactly where I expect the sellers to be, because buy low, sell high. They're not going to they want the best prices. So best prices are the highest prices to sell. You know, just like buy low over here is buy low, right? Sell high, buy low, sell high. So it's like you know, just common sense. And they sell it. When they sell it, what happens? The market falls back. It retests that area, that selling area, right? So this is the selling, the 20,000 plus the 17,000 plus the 27,000. What happens? The buyers get filled. All of them are filled by this selling, leading to lower prices. As it goes down, there's one more rally up. I don't trust the buying here on this up move because there's no big buying here. As you can see, it's just like one bar and then go straight up. So that could be covering. And that's why the sellers who re-stepped in here sold it back down. Now this is where it gets interesting. As it's coming back down, right, the buyers were not here. Well, how do you know? There's no volume. Whereas you have 20,000, 27,000, which caused the price to go down. Do you have any buyers here? Like heavy accumulation or reaccumulation? No. So this up move is baseless. And then it comes back down. And on the way down, 22,000 start picking it up. Now, I don't know whether that 22,000 is bullish or bearish, but I do know that it's near this support. So I'm leaning more towards the bullish side, and you really won't know until the rally. So but I know that this is the prior area went up, they sold it, took it back down, retested, took it back down. As it went down, reaccumulated 22,000, and then bang, right here. This is where we just really marked up. And now up here on these resistance levels, you have 20,000 and 70,000. That's the end of the day. But if it kept on going, if the market kept on going, what would be the area to look at? Right here, 34,000, right here. Lot of demand area, and the place right under it was 22,000. So chances are, if the market kept on going, it pulled back to this area of aggressive buying, there'll be a bounce. All right. So this is the supply and demand. And if you're wondering where this comes from, it's all Wyckoff. This is literally Wyckoff, what he used. I just adapted it so you could use it for today's larger box sizes, because when he did it on a tick by tick basis. So obviously you can't do that now, right? Because the volatility and the volume is just not possible. So the way you just adapted using software. And that's it. All right, let's go to the next market. Gold. This was a wonderful trade today. And what happened was market went down, and as soon as I saw this, I knew these guys they're in, right? Because this is their footprint where it does a shakeout. This is the 4,000 contracts. It's a breakdown, right? But they buy the breakdown. Okay. Typically, this is what they do. Anytime the volume has a break, any chart you look at, it's going to show an increase of volume. Here, when they break, it goes from 1 to 3. Here, it goes 1 to 4, and there's some distribution in the background. Anytime there's a break, this is a fundamental characteristic of the market. It is an attribute of the market. When you break highs and lows, there is liquidity there. There are stops there. The evidence of that is that if you look at any goddamn chart, you'll see that when it takes out the high or the low, generally the volume increases. In almost any market, any time frame, this is a characteristic of the market. This is an attribute of the market. And the reason is liquidity is there. And this undeniable fact. Backed by evidence. You take a look at any chart, you'll see this. Any chart. Any time frame. Any market. So this is, again, what happens is it tries to break this low. When it does that, 4,000 contracts come in. The other side is taking the 4,000, where one side is selling, the other is buying. As a result of that, right, the market, you're looking for continuation down, but what happens is this rally occurs. This rally says that this, a strong hand accumulation. When that happens, and the rally is on 2.8 times average up column volume, right? We look for a pullback, but it never pulled back. So, I mean, it never pulled back. So, no point, right? And that's what happens, and that's fine, because next time, Monday, Tuesday, Wednesday, whatever, what's gonna happen? It will pull back, and it'll give you the test to get in and ride it. You got to know the principle. You have to know whether it's the accumulation, distribution, the result of it, all of that. And basically, this is on a shorter time frame or time scale or box size. This is a shakeout or a spring. This is exactly how they look. If you look at the bigger charts, they'll look the same way. Drive down and then buy it all back up into a rally. Right, this happens all the time. Right, that's why I see it immediately. I know that, okay, I know what's going on. Right? The only problem is the damn thing didn't pull back. And then over here, this is heavy buying. And we see here 5,000, 5,000, 6,000. And look at this. As you made this break down, it was bought, meaning shakeout. This is a shakeout in the opposite direction. Why? Same thing, but it's flipped in reverse. See, down followed by up, up followed by down. This is how they look. This is the shakeout. And this is actually the biggest volume in 49 waves. If you don't understand what's going on here, you're going to, like, if I show this, you're going to say, oh yeah, very bullish, oh, consolidation, accumulation, blah, 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 goes up here, right? What you need to do is wait and see what happens as a result. We see that after this rally, first of all, there's heavy volume prints right at the very top. That's already a bad sign, because buy low, sell high, they're selling high. How do you know? The largest print is on the top. The largest print is on the top. Do you think there's a buyer? No, it's professional selling coming in. Second is, you look on the pullback, it's just too much volume. Base of 49 waves. Third is, on the pullback, they take out the low. So it's game over. Now, as they go below this liquidity level, closer into the base, you see it's picking up. It's picking up volume. Now, but do you know if it's bullish or bearish? You don't know. However, the fact that it bounced here is helpful, because it means that their buyers stepping in, they're overcoming the supply, meaning whatever you sell, you want to sell 5,000, I'll buy 5,000. Until you can't sell no more. And in that situation, and that's how you want to read this. Over here, you want to sell 4,000? No problem, I'll buy it. You want to sell 2,000 more, 2,000 more? You see how it's decreasing? Because you have nothing more to sell, leading to price going up. Here, you want to buy, I'll sell to you, sell to you, sell to you. Oh, no more buying? Guess what happens? Price goes down. Here, you want to sell 5,000? I'll buy 5,000. Do you have any more to sell? No. Price goes up. So there's no, is this selling volume or is this buying volume? Volume is volume. It's both sides. The important part is what happens afterward. If it goes up, that means the sellers have no, whatever you want to sell, I buy. And the selling is exhausted. And that's why price popped. All right, so we're done with this market. Now we'll go into crude. This was a really good, but it's a little bit complicated, meaning it's tricky. in that there's shakeouts and things like that. All right. All right. So over here, I can't really tell. All I know is that there's selling here. That was the breakdown selling, and it's holding price. It's holding price. Makes a lot of sense. All right. So this is the selling block. You can very clearly see it's 4,000. I think it's 4,000 contracts. So it's a wall of resistance. Why? They sold 4,000. They might sell more, right? So I don't really see any accumulation. I see selling, ding, ding, sell some more, except here. Here on this drive down, 3,000 contracts picked up. Right here, 3,000. Now, do I know this bullish or bearish? No. But why is price going up after the buying of 3,000 contracts? Because buyers are selling to buyers are buying from the sellers, and sellers are selling to the buyers. On one side, it gets exhausted. So as one side gets exhausted, price goes the other way. So here, sellers are selling, buyers are buying until sellers get exhausted, leading to price going up. When it goes up, it lifts, and these numbers here, 3,000 and 5,000, this is the aggressive buying taking out this resistance area. So 3,000 followed by 5,000, 8,000, going back into that resistance area right here, where you have the 4,000 contracts that sold here and sold here, but the buyers are not trying to make a stand. All right, they're going to take these guys out. And one indication of that is that it's green with 3,000 breaking that high, that middle high, plus 5,000, which is more than 4,000. Okay, so now you have to make a call. You know what's going on, because you have volume on the way up near the lows, indicating buying low, leading to higher prices. Demand. There's one, you can call it a test or a shakeout, because it goes right below this low, right? That's actually a shakeout, but it's a minor shakeout, which is known as a spring. Springs this low, and aggressive buying. Once you have this aggressive buying, and they take out this area, the 4,000, right there, they took it out. The trend, it's rallying and it's broken this area, and now it's just a matter of whether you can get into the pullback, and that's about it. It goes down, And the buyers came in right here, right there. You see? That's the highest print in this block, and that's the highest print in this block. Boom, break, pull back, reaccumulate, take it up. Here it goes up, 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 up. Here you got too much volume. Does it hold? Doesn't hold. If it doesn't hold, it's distribution. Anytime you have high volume at a high, it doesn't hold, distribution. And at lows, high volume, doesn't hold, goes the other way. What is it? Accumulation. That's the nature of volume at price. Because a characteristic of distribution is that you have high volume at the very top, and that level doesn't hold. Doesn't hold and breaks through. It's a characteristic of distribution. This is too much volume up here with higher prints at the high, at the extreme high, followed by its low being broken, selling, and price goes down. So where were the trades in this accumulation area? This was one of them. If you know how to buy a spring, this is the spring of this low, which led to higher prices. This is also, if you know how to buy this spring, it's great. How do you know this is going to hold? You don't really know, but you know that there's support there. You don't know if that support will hold, but at least you have indication that there's a good, strong support there, and you don't take trades without support. And by support, I mean accumulation back support, meaning you are leaning on heavy players. You are leaning on big volume, big buyers. How do you know? This guy. You see this 3,000? When it breaks and comes back down, if you're going to buy the pullback, it's because there's these buyers here, this 3,000. Right? Just like if you're going to sell on the pullback, you have evidence of prior selling, and that is an indication that there's sellers there. Without that, I mean, there's no reason to buy or sell if you can't see whether large interests are at those same levels and have traded, because it's just gambling. The forces of supply and demand are caused by large interests moving price in one way or the other. This is their footprint right here. This is a footprint. This is a footprint. By footprint, I mean heavy accumulation. Here's the selling, the break. You see hold, you know. And then bang, right here. This is the key. The fact that from this accumulation, and you don't know it's accumulation, it could be bearish, but it went that way. Why would it go that way if this was selling? Yes, it's selling, but it's selling getting exhausted, and the buyers are on the other side. So sellers are selling 3,000, buyers are accumulating that 3,000. Underneath it, nothing. So they're exhausted, leading to price going the other way, leading to bullish activity and a reason to buy the pullback, because selling dried up, because buyers bought it all up, taking price the other way. This is a Wyckoff toy. All right, let's go to a Wyckoff chart. All right, so this is a study, Wyckoff study. I'm not going to go through the study, but basically this is actual Wyckoff course, and I want to go through where it says, from here on, it is suggested that students use this combination chart for working out correct trades. What is the combination? Is this not what I just showed you? Let's flip it. How do I flip it? We're going to flip it. God damn it. Anyway, I don't know how to flip it, but this is what I just showed you on my screen. You see all the numbers? See that? All the numbers? So what I was showing you is the top chart. I can't flip it, so just turn your head, or right. So this is the tape reading chart. It's what he used, and underneath it, it's the wave chart. See the wave chart? So the tape reading approach that Wyckoff, from here on, it is suggested that students use this combination chart for working out correct trades. What is the combination? This is the combination. All right, so this is the combination of wave chart with the tape reading chart, which is what you need. This is from. If you want to learn more about this, you can go to Wyckoff SMI. Wyckoff SMI. They have good. I think they have not only. I mean, these PDFs have been around for like 100 years, but I would suggest go to Wyckoff SMI. They have great stuff there, and they have online version, clearer and easy to understand. And you want to get the online version so you can see it in the browser instead of having PDFs, and clearer. So that's all I got. Thank you. Bye.